All right. Happy Friday, everybody. What's up, guys? I'm Nobody Special. Welcome to my Friday afternoon live stream, my favorite time of the week, when I get to sit down with all of you fine people, wrap up the week and everything we saw. And boy, what a week it has been. Stocks marched straight up and to the right all week. We had the CPI data came out. Market liked it. We had the Fed came out with the pause. The market liked it. We had Janet Yellen dumping U.S. Treasuries on the market, hoovering up liquidity. The market liked it. The market likes everything. You could walk up to this market and punch it in the stomach, and it will say thank you and move higher. And that's why, with a little help from ChatGPT, I might add this morning, we've got stocks, the eternal fountain of unending profits. Numbers will only ever go up, right? That's what stocks do. They just go up. Endless. Macro doesn't matter. Valuations don't matter. Fundamentals don't matter. Stocks just go up. That's what they do. They're going right to the moon and they're not going to stop. That's what I'm being told. That's what CNBC is telling me. That's what everybody who says AI and then holds out the hat asking you to buy another few hundred shares of their company is telling us. We're going to look today at a lot of the market fundamentals. We're going to look at things like PE ratio, Shiller PE ratio. What are the actual S&P 500 earnings doing? What are the companies doing in their earnings report? What's oil markets doing? And what is going on over at the Federal Reserve with their balance sheet? We're going to look at a lot of these things, folks. And look, I got to call it like I see it. I don't chase FOMO rallies. I don't chase manias. And I see the macro picture for what it is. I see what's happening, exports and imports. I see what's happening in China. I see what's happening in Europe. I see global trade slowing. I see the cost to move goods across the ocean and across our highways is going down, both the fuel cost and the actual cost to hire a truck to move the stuff. It's all going down, and yet the stocks just go up. I see earnings forecasts going down, and yet I see stocks going up. So one of these things is not like the other. Either the entirety of the macroeconomic picture, all of this data that I talk about day in and day out, the PMIs, all right, the earnings reports, the oil inventory counts, the rig counts, all this stuff. Either all of that data is wrong or the stock market is wrong. Pick one. We're going to look at a lot of that stuff, and we're going to get into it today. And before we get into anything, I have to once again thank the sponsor of today's live stream, Patriot Gold Group. Guys, I like gold because it is a safe haven asset, and there is no better place to hide during a bubble that is about to pop than in physical precious metals, especially when you consider what is going on in the banking system. And we're going to talk about what's going on in the banking system today, in the commercial real estate bubble and all these vacant office buildings and how overexposed our banks are. The Federal Reserve and the people pulling the strings in this market are leaving fewer places for people to take safety, for people to hide. But gold is one that they can't take away, and that's why I like the ownership of physical precious metals. And that's why I'm happy to endorse Patriot Gold Group. So there's a link down in the description to nsfgold.com, or you can call 888-988-5401 and ask about their no fee for life IRAs. Get your free investor guide. And of course, as always, be sure to tell them that nobody sent you. And now we're going to bring in my man Mish, and we're going to shrink my big melon of a head here. Mish, how we doing today, brother?
I'm doing really good. It's Friday. I'm done traveling after, 13 hours straight yesterday. So I've been kind of chilling out today.
I mentioned it over the phone. You are a true road warrior, sir. You are Mad Max incarnate. I don't know if you're still driving the last of the V8 Intercepts, and if you have the brace on your knee and the dog at your side, but it's still true road warrior. So be a soundboard here, Mish. Keep me sane. Am I way off base here with my perma bearness? Is it time for Jack to go bull? Or
well, there's a lot of indications. We've been talking about this for a while. Manufacturing's down. Unemployment's been really sticky low. I think that's going to be a big thing, but I think there's other things out there driving that, not just unemployment. And so a lot of the things that are pushing what we think are pushing the economy down are out there, but it's just getting ignored and has been since I've been here like a year and a half. The stock market does not care. I mean, yeah, we had a we had a bear market, and now we're, boom, 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 we're back up.
Yep. And boy, are we back up. I mean, we are We're way higher. I mean, the market has shrugged off bank failures. The market has shrugged off aggressive central banks. The market has shrugged off lousy economic data, and it's only gone higher. Now, it's only been a handful of companies that have dragged the market higher, and it's because AI. I mean, that's basically it. AI is like the new blockchain, or whatever issue was fashionable a few years ago that was causing market bubbles. I mean, it's look at here, right here, CNN Fear Greed Index at 82. It touched 83 this morning. All right, now this is actually a really good indicator. Forget the letters that are attached to it. Fear Greed Index is actually pretty good. It's made up of several indicators. And I just want to show you this timeline. This is the Fear Greed Index going all the way back a year. And we are higher than we have been all year. We're higher than we were in February at the highs. We're higher than we were in December. We're higher than we were at the highs in August. So this is the point right here where markets typically turn and catch their breath. So I did a thing today. I put my money where my mouth is. I went and I bought some calls in SQQQ. I bought some August 20 calls for SQQQ. I am short the NASDAQ. Admittedly, that has been a losing trade year to date, betting against these indexes. So I've had a couple of duds this year, me and my perma bearness. But I got to call it like I see it, guys. Sooner or later, that broken clock's going to be right. And right now, looking at where we're at on these fear greed indexes and looking at some of the other indicators I'm going to show you today, this market is ripe for a turn. But let's look at the S&P. Go ahead, Mitch.
Yeah, I was going to say, I talked a little about it in Discord, but I'm taking profits right now on the market. Two of my plays were 20%, so I took it because I don't trust the market right now. It's too volatile, and if you don't take your profits, then you forget a day to look, and then it's boom down. You've lost it all. So take profits on the way up if you can.
Absolutely. No, nobody ever got hurt taking a profit, right? And let's say you take a few profits. You don't have to sell it all at once. There's no law that says you got to sell all your stock all at once. You can take a portion of profits, right? And then if you're wrong and stocks move higher, then you can take your $100 bills and you can wipe your tears away with the profits that you booked, all right? But if you're right, then there will be no profits. And that is the whole point of this, right? Is to make money. So, you got to remember here, if it doesn't matter if it goes way up, if you never sell it, then you never take the profits, you never actually made money. And then if you hold too long and it comes right back down, well, then you never made any money either. S&P 500 right now up 10 points. I'm sorry, down 10 points for the day, or 0.22%. Let's talk about the S&P for a little bit here. This is the S&P this week. All right. Fantastic week for the S&P 500. We started the week around 4,300. We're at 4,415 right now, up over 100 points on the week. All right, so S&P is looking great. But let's zoom out a little bit. Let's go to a one-year chart in the S&P. All right, actually, let's zoom out even more. All right, we're still looking at one-day candles here. This is something I've heard Mitch mention a lot. This is your return to normal. Which, guys, return to normal is not a good thing. If you know what I'm talking about in the return to normal, that's that famous chart of a mania. And that return to normal is the opening innings of a market crash, of a bubble popping. And I have to point your attention here, guys. Look at the RSI and the S&P 500 right now. And these are one-day candles. The RSI, what are we at? Over 70, pushing 80, guys. 74.5, the RSI on the S&P 500. All right. The last time we were here, remember I mentioned August was one of the highs for the CNN Fear Greed Index back here in August of 2022. Well, the last time the RSI and the S&P 500 was anywhere near the level it's at right now, well, there you go, mid-August of 2022. And what did the market do? Right back down it went. It made an abrupt U-turn. All right. And, let's talk about the Dow for a minute here. Come on, Dow. All right, the Dow's down 66 points. It looks like it's selling off a little bit in the close today. I want to add today is quadruple witching, which is it comes in the middle of the last month of every quarter. That is the day when stock options, index options, stock futures, and index futures all expire at the same time. They can be liquidity challenging. So it could be a little bit of fireworks in the close today. It's not automatic, but there could be something to watch for. But the Dow's down 66 points right now, 0.19% at 34,341. The Dow had a fantastic week. Go to a 5-day chart here. The Dow started the week around 30, right below 34,000, about 33,950. Currently at 34,340. So Dow's up a few hundred points, pretty much marched straight up all week long. We had a little bit of a sell-off In the initial moments after the Fed announced their rate pause, we came right back. We're higher than we were going into that. So the Dow had a really good week. But let's zoom out a little bit. Let's go to a 1 year plus change. Now, I got a little blue line there, right around the level we're at, because we've hit this level a few times and it's been resistance on the way up. Now it looked like we were right into breakout territory here, but we're threatening to close below this line now. So we could see a failed breakout in the Dow today. The RSI in the Dow is not quite as bad as the S&P. It's in the high 60s still, but it's not as obscenely overbought as the Nasdaq or the S&P is. And speaking of the Nasdaq down 75 points now, 0.54% on the day at 13,707. Looking at the Nasdaq for the week, Nasdaq had a phenomenal week. We closed last week around 13,260. Right now, sitting pretty at 13,700. So 440 points on the Nasdaq this week. Fantastic week for tech companies. Somebody must have sneezed AI somewhere. I don't know. All right, but again, we're going to zoom out again. We're going to go to a 1 year chart. We're going to zoom out a little bit more. Look at the RSI on the Nasdaq, guys. All right. If you're buying here, you're chasing a mania. You're FOMOing in if you're buying here. When the RSI is in the mid 70s, pushing 80, higher than we've been since, look at that. The end of the third quarter, beginning of the fourth quarter of 2022. Let me shrink this a little bit. The last time the RSI was anywhere around here, that's right. That was the all-time high in the Nasdaq. And what did we do then? We abruptly turned lower. Remember the CNN Fear Greed Index that we talked about back in August when it hit highs? Oh, there we go. There was the RSI back then in that mid-August reversal, and there's what the Nasdaq did back then. All right, so that's why I took a short position in the Nasdaq today, because all these indicators, the momentum, the fear greed indicators, they are all ripe for a reversal. And I'll be honest, the bullish case for stocks is just AI. That's it. That's the entirety of the bull case for stocks. Like, maybe the banks don't fail next month. That's not a bull case, guys. That's just the absence of catastrophe. The absence of catastrophe is not a good thing. It's just Tuesday. So that's not really a bull case. Hey, it's been a month since a bank failed. Things are looking really good.
Well, in a scientific thing, absence of outcome is worse than a negative outcome.
If you elaborate that, you're getting a little philosophical on me there. Elaborate on that a little bit.
So if you do something and you're saying, okay, this is what a positive outcome is, this is a negative outcome, and it meets in the middle, so it's a non-conclusive outcome, you've just wasted your time because you're not proving it either way. So you don't want a neutral outcome. You need a positive negative to actually support what you're talking about.
And I would add to that, and I like that thinking. I've never heard that before, but that sounds accurate. I would also add that a lot of people are misinterpreting a non-outcome as a positive outcome right now, and that's the wrong conclusion to draw. Again, just because a bank fails, it's not a good thing. It's just absence of a bad thing. And if you're interpreting it as a good thing and you're acting upon it as if it's a good thing, then you may be taking the wrong action. Now, we talked about the other two indexes. I want to go back to the S&P again real quick here, because I looked at a couple things. Somebody was asking today, how do we know stocks are overvalued? How do we know stocks are expensive? And there was a lot of references to inflation are made. Understand, when you buy a stock, what are you really buying? You're buying a share of earnings, right? You're buying a percentage of the company's profit when you buy a share in a company. That's ultimately what the point of companies is, right? It's to earn money. I realize it's the era of blowouts in the NASDAQ and hyper growth companies that don't ever turn a profit. They just grow their top line, but they never actually achieve profitability. But remember, at the end of the day, the point is to make money. So the very easiest way to measure is a stock valued, overvalued or not, is to look at the PE ratio. Now, this alone is not the only data point you want to look at, but this is the price of the stock relative to how much money the company makes. All right, now this is the S&P 500 PE ratio going all the way back to 1880. All right, so we're not at some of the more obscene highs we've ever seen, right? At the height of the dot-com bubble, we were a lot higher in the S&P 500 PE ratio. Now, in the GFC, this massive spike here, that's a little deceptive, because that was the earnings in the S&P 500 rapidly falling before the values of the companies fell. So the PE actually exploded higher for a moment there, and then came right back down lower once people realized, hey, this is for real, this catastrophe. Now, the historical averages, right? The mean, which is the average of all these data points, is 16. And right now, the S&P 500 is trading at 25 and a half times earnings, when the historical average is 16 times earnings. So just looking at history, the S&P 500 is way, way overvalued. And if you look at the median, which is probably a better average because the median doesn't give so much weight to the outlier data points, but where the S&P has spent most of its history has been at 14.9, about 15 times earnings. So here we are trading at 25 and a half times earnings. So by the simple measure of the S&P 500's price to earnings ratio, stocks are way overvalued here. Now, there's other ways you could look at earnings. There's the Shiller PE ratio. Now, the Shiller PE ratio, same concept as the standard S&P 500 PE ratio, but this one is the price to earnings ratio based on an average inflation adjusted earnings from the previous 10 years. So this one smooths out some of the flukes in the data point, right? For example, when you smooth out this data, you don't get that blowout number from 2008, 2009, because that number gets averaged out across the previous 10 years. So according to the Shiller PE ratio, which a lot of people view this as a much better relative valuation for stocks than the straight up PE ratio, we're trading at 30.9, almost 31 times the 10-year inflation adjusted average of the S&P 500's earnings. Now, again, the mean, the average of all these data points is 17. The median, where we've spent most of history, 15.9. We'll say 16. So again, you're seeing here between 15 and 17 times earnings is the historical average of the valuation of the stock market. And we're trading at, depending on whether you look at the pure PE or the Shiller PE, 25 or 31 times earnings. Way, way overvalued relative to history. Now, these are inflation adjusted numbers, so you can't just say, well, inflation, and that's why it's higher. No, guys, because the earnings rises and falls with inflations too. Now, there are some times when paying a higher multiple of earnings, when paying a higher PE ratio is justified. For example, when earnings are rising, you tend to pay a higher premium for those earnings because you want to price in future growth of those earnings. That's why the NASDAQ, which tends to be more growth heavy, tends to trade at much higher valuations than the S&P 500 because they're growth companies in the NASDAQ, and they tend to increase over time their earnings. So let's forget the PE ratio. Let's just look at what the earnings are doing. Maybe this valuation is justified based on an increase in earnings. Well, here we go. This is NASDAQ.com. This is a monthly snapshot of the S&P 500 earnings per share. All right, this is the earnings. This is going back to the late 2019. What the earnings in the S&P 500 have been doing. Now, earnings rose all through 2021. Right, that was the stimmies, that was the helicopter money being juiced into the economy. So everybody was making more money. But you'll notice here, since December of 2022, since right around the time the S&P 500 made that all-time high and the NASDAQ made that all-time high, the earnings in the S&P 500 have been falling. They've been falling steadily. So if we need to see earnings growth in order to justify higher valuations, we're not getting it. We're getting shrinking earnings. And when earnings are falling, you tend to get multiple contraction. But that's not what we're seeing right now, guys. We're seeing earnings are falling, but the multiples are going up. The price of these stocks is doing the opposite of what the fundamentals of what the valuation should be doing. And that's why another reason, besides all the macroeconomic data, if you just look at how expensive these companies are at the price tag, I get it. I'm a weird guy. I actually look at the price tag when I buy things. What a concept. It's overpriced by any metric. And because these earnings are falling, we should be seeing rapid multiple contraction. We should be seeing the PE ratios of the S&P 500 falling fast. And we're not seeing that. But it gets worse. Check this one out. This is from June 1st. Business is slowing, so companies are juicing profits. Now, I talked about this a few weeks ago on my Patreon Zoom call. Shout out to my Patreon people. Thank you guys for everything you do for the channel. But check this article out. Reallocate costs, unwind charges, delay depreciation. Companies are using non-traditional ways to boost the bottom line. In other words, creative accounting is on the rise to make it look like these companies are making more money than they actually are. This was on June 1st in the Wall Street Journal. Business slowed last year for Google's parent Alphabet. The tech giant still beat earnings. They still beat earnings expectations in the year's first quarter, in part because it said that its computer servers would last longer than expected. The shift reduced its depreciation expense by nearly $1 billion and helped push per share earnings ahead of analyst estimates. Google isn't alone in boosting its earnings in surprising ways. When business slows, companies often try to make their numbers look better, and that appears to be happening now from tech giants to used car dealers. And of course, a spokesperson for Google declined to comment. Almost the entirety of Google's big earnings beat in the last quarter was because they just decided, you know what, the servers in our data centers, they're going to last longer than we told you last quarter. So we're going to take away a $1 billion depreciation expense and make it look like we actually earned more money than we really did. This is creative accounting. And that was a $1 billion jump in Google's earnings. And there's a couple of metrics they talk about down here. A report published Thursday in research from CalcBench compared the net income based on accounting standards for 200 randomly selected companies in the S&P 500. So this is a big data set, 200, almost half of the index, with their adjusted net income, which can include or exclude items that would be normally counted. The adjusted numbers were higher by $1.1 billion on average last year, an increase of more than 130% over a similar sample taken from a year prior. So out of 200 companies sampled, the adjustments to their earnings, some of their creative accounting, added $1.1 billion to earnings on average. And this is 200 companies, guys. So what do we got? $220 billion in earnings for the S&P 500 that just magically appeared because they changed the way they count things like depreciation amortization. Another measure used to predict the likelihood of earnings flattery is the Benioff M-score, named for its creator, Indiana University accounting professor Mesud Benioff. I apologize if I'm getting your name wrong, sir. Recently, academics found the aggregate score of a sample of nearly 2,000 companies was at its highest level in more than 40 years, the most recent data shows. Historically, the aggregate score peaks ahead of a downturn. So what they're talking about here is this Benioff M-score measures how much companies are juicing their earnings with creative accounting standard. It's higher than it's been in 40 years, and historically, this thing peaks right before things go very wrong in the stock market. So again, I want to take you back to the earnings situation, because again, higher valuations, which we've already established, the market is trading at historically very high valuations. It's only justified when earnings are rising. Well, earnings aren't rising, they're falling. And not only are earnings falling, but the earnings numbers are being artificially inflated by creative accounting, which historically, when that happens, it precedes something very bad happening in the stock market. So guys, I'm not just negative perma-bear Jack here. I bring receipts. There is math behind my negativity when it comes to this economy and why I'm so negative stocks. Now, apparently none of the charts, none of the math, none of the indexes, none of the indicators matter because somebody said AI. That's going to be true right up until it isn't. And once that stops being true, you better look out, because as much as 7 companies juicing their numbers and saying AI on their earnings call can make hundreds of billions of dollars in market cap just appear seemingly out of thin air, it can vanish even faster when one of those 7 companies puts something even remotely negative about their growth outlook in their earnings call. And earnings will be starting next month. Go ahead.
I think the nature of risk is kind of what we're talking about here. There's always non-zero risk on anything you do. It's just the way it is. There's always a risk of something happening, no matter how remote. But as that risk starts mounting up is when you have to start looking at different options on what you need to do for risk mitigation, which is when things get too frothy, you need to be ready to mitigate.
And talk about things you can do to mitigate. All right, let me bring this chart up here, Rick. M2SL. All right, we've looked at this one a while. By the way, a lot of people have been talking about saying I'm mistaking deflation for stagflation in a lot of my commentary when I've been calling for deflation lately. Respectfully, that's not what I see happening. All right, a lot of people, a lot of channels that I follow, a lot of my peers, people I respect their opinion, and they're very smart guys, and they're very well informed and very well researched. They're saying stagflation. All right, if you're not familiar with what stagflation is the seemingly impossible scenario, according to the Keynesians, that you can't have high unemployment and high inflation at the same time. According to the Keynesian Phillips curve, typically if unemployment rises, you get inflation falling, and typically when inflation rises, you get unemployment following. It's falling. It's basically, if people make more money, they spend more money. All right.
Well, the
Well, the
problem with that is because everybody, if you watch this channel for a bit, you know how I feel about Phillips. I love Phillips, but I think when it comes into it, is that that mechanism he's missing there is he didn't account for government overruling the wage push portion of his curve, right? If it goes below his nominal curve, you're supposed to get the wage push inflation to push it back up, right? Well, if you don't get that wage push, it totally knocks him out of the picture, and you have to throw him away because that mechanism isn't there, and his curves become untenable. And
yeah,
that's why Phillips fell out of favor in the 70s because it really didn't work.
my problem with Phillips is mainly it makes no allocation for productivity, right? Unemployment and inflation. It basically, you can have higher unemployment, you can have wages rise and get no inflation if you get large increases in productivity along with that rise in wages, right? Because when you get increases in productivity, you get more goods produced to justify the higher wages. So yeah, there's more money, but there's also more goods. There's no net change in the supply demand relationship, but prosperity rises, but you don't get the inflation with it. So
Well, then you
that's
have to
my
look at
biggest.
wage per
Yeah,
unit produced. And if that's
absolutely.
constant, that means wage and production staying the same.
Yeah. And right now that's actually in decline. Productivity is in decline in the US. But the big reason why I don't see stagflation right now is the M2 curve, right? Look through the 1970s. It's hard to see on this chart right here, but the money supply rose constantly through the 1970s. So while we had the high unemployment, we still had an increase in the money supply. We still had governments producing more money. We still had credit expansion. So that allowed for the higher inflation. It's not impossible, but it's really hard to get high inflation when there's less money. Because if there's less money, there's less money to chase those goods and services. Right? If there's less money but the same amount of goods and services, then the goods and services start competing for less money, and they do that by lowering their prices. That puts downward pressure on prices. I know we're not seeing that yet, but I think we are going to see that very soon unless they start increasing the money supply again, which is it could happen. I think my guess is there's a lot more pain before that starts. But that's my big reason why I'm not in the stagflation camp, at least not right now. I still see the money supply shrinking. And stagflation, higher inflation is going to be harder to see with the money supply shrinking. That's my biggest difference between now and the 1970s. Also, the debt pile in the 1970s wasn't nearly as large as it is right now. And with a shrinking money supply and a debt pile the size we have, the risk of default, case in point, the commercial real estate market, the risk of defaults actually risks accelerating the decline in money supply because when debt goes bad, money is destroyed. So the commercial real estate bubble popping, and if residential real estate follows suit, or if we get some other form of default, like say a lot of junk bonds defaulting because companies go bankrupt because banks aren't lending anymore, not as much anyway, well, then we could see the decline in the money supply accelerate further, and that could cause rapid onset deflation, i.e., a recession, a deflationary recession, or a market crash. Um, how did I get
Well,
to
there's
M2 money
several
supply? What was I?
well, there's several theories that are being tested right now that weren't tested back 15 years ago in the last market downturn. We've got the cryptocurrency, Bitcoin and cryptocurrency. I got it. I'm saying different words here. Has never been tested in a market downturn. Monetary theory has never been tested in a deflationary downturn because it really started in the 90s ish. So it didn't go through the 70s nightmare. So there's these two, three different systems here that have never been tested. So we really don't know how they're going to respond.
Yeah, and I mean, I could give you my theory on what the Fed is going to do. I mean, we saw how they created the bank term funding program the second things got difficult. So I do think they ultimately they burr again. And when they burr again, you better believe inflation will come running back. And Joe Brown did a fantastic video earlier this week over at Heresy Financial about why he thinks structurally nothing has changed and we're still on an inflationary path. And I agree with that, right? We have unfunded liabilities. We have a $31 trillion debt that's on its way to $50 trillion. We have an increasing interest expense causing blowout deficits. These are all inflationary things. But the Fed will eventually monetize that debt. But right now, the Fed is still in tightening mode. And right now, the money supply is still shrinking. So I think we get deflation. And deflation is a nightmare scenario for the Federal Reserve and for the U.S. government because they're the biggest. The U.S. government owes more money than any entity in history. And so you cannot have deflation when you have a big debt because that debt becomes unpayable. And so that's why I think ultimately they do turn the printers back on and we do go back towards inflation. But I think between now and then lies deflation and this shrinking money supply. I mean, think about it. As money gets more scarce, but the demand for money stays the same, the value of money goes up. And right now, it's hard to believe, but here it is, M2SL. The money is getting more scarce. And so as money gets harder to come by because there's less of it, but people still have the same appetite for goods and services, they're going to start selling things to get more money in order to go buy those things. So I think you're going to see asset prices start to sell off here. And, much the way when new money enters the system, the first thing it does is chase assets. When money leaves the system, I think one of the first things it hits is asset prices. And isn't that what we saw last year? Didn't we see bonds go down last year? $600 billion of unrealized losses on the bank's balance sheets. Didn't we see stocks go down last year? We had our bear market. I mean, now we're back into a bull market that's reversing. Didn't we see crypto go down last year? I mean, we're already seeing asset prices come down. Not all of them, but most of them. All right, we went through all the stocks. What do we got today in the DXY? The DXY is up 16 basis points right now. Slightly stronger dollar this morning at 102.27. Still down way off its highs after yesterday's sell-off. Let's look at what we got in the the bond market right now. Let's see, the yields largely higher across the board. We got the 10-year yield up 4 basis points, 3.76%. The 2-year down off its highs from earlier today, up 8 basis points or 4.7. Looking over at commodities, we got gold up. Nope, gold down, $1.75, 1,968. We got silver is up 27 cents right now, 24.23, up 1%, 0.15. Let's talk about oil. Oil's having a good day, up $1, 71.71 for oil, up 1.53%. First things first in oil, domestic
I was
supply
going to say,
falling.
go back to the Dixie real quick and make sure I'm seeing it at 101.8.
101.8. Okay. Let me go to TradingView real quick and just make sure I'm looking at the currency index. There's a couple of different versions of the DXY. I may have put, here we go, the currency index. I am still seeing 102.27 also on TradingView.
Okay.
Yep.
I watch a little different Dixie than a lot of people do. I watch the futures, which tells us where it's going. Sometimes it takes a minute to get there.
Yeah. All right. Where were we? We were on commodities. Commodities. Here we go. All right. Let's talk about oil. Up $1 today. Looking better today. Now, the Baker Hughes rig count. This is something I've been following the last couple of weeks. And this is worrying at least medium to long term because U.S. oil rigs are shutting down and that pace is accelerating. We spent most of the beginning of the year around 590 and change. And really since mid-April, we've started to see oil rigs shut down. All right, and then we took a big step down at the end of May. Gained one last week. We just lost 4 more. 552 operating oil rigs, according to the Baker Hughes rig count. So this is U.S. domestic oil production potentially in decline here. These are less productive wells. These are less economic wells that are shutting down, but there are not enough new wells coming online to replace them. And so domestic oil production is falling. This is a vulnerability for the U.S. If things with OPEC countries get even worse, which they always can, this could become a problem. But let's look a little bit at the chart here in oil. Now, I got 3 arrows pointed on here. This is over the last couple of weeks. This is going back to October of last year. These 3 points right here. The first one I want to point to is March 31st into April 1st, April 2nd timeframe. That was the first announcement of that surprise OPEC oil cut. Here we go. April 2nd, OPEC Plus announces surprise output cuts. All right, that was back in April. That really surprised the whole world. And oil prices did gap up that day, and they stayed up. They crept down a little bit. They had a good couple of days. Recaptured its 50-day moving average, which was acting as resistance prior to that. And then we came right up and touched the 200-day moving average on WTI crude oil. All right, and that's when we get to this second arrow. What happened on that day? That was the day OPEC released this report here. This was in Reuters on April 13th. Oil drops 1% after scaling multi-month highs on OPEC's demand warning. Now, the Organization of Petroleum Exporting Countries flagged downside risks to summer oil demand in a monthly report on Thursday. This was back in April, highlighting rising inventories and challenges to global growth. The report shed light on the reasons behind the surprise production cut announced by OPEC Plus, which includes Russia and other OPEC allies at the start of this month. So when OPEC released this report that said, we're really worried about summer oil demand, all of a sudden that production cut started to make sense, and people realized, hey, this wasn't part of some offensive or some effort by bin Salman to screw over Biden. You know, things between the Saudi crown prince and President Biden are not exactly simpatico at the moment. They hate each other. But when that happened, that showed that, hey, that production cut was a purely defensive move, that they were just trying to get out in front of a severe decline in demand, aka a global recession. Remember, in recession, stock earnings go down. We spent all the day talking about declining earnings and PE ratios, right? So with that, oil started to sell off. It failed to retake its 200-day moving average. It kept falling, lost the 50-day moving average, came back up, touched the 50-day moving average again, fell again. And then we had that announcement 2 weeks ago, or was it? Yeah, it's about 2 weeks ago now, with another million barrel per day production cut from OPEC Plus that we got at the beginning of this month. And oil rallied that day, but you notice it came right up to the 50-day moving average, hit its head, said, and then went right back down. And it's kind of been selling off ever since. Right now, it's just below where we were before we got the announcement of the OPEC 1 million barrel per day production cut. So think about this, really. We've got 2 million barrel per day production cuts. Now, I would mention that this, I think, is partially offset by increases in Iranian production. That's going on out there. But 2 million barrels per day of production cuts since April. That's enough right there to wipe out all of the barrels of oil that were dumped from the Strategic Petroleum Reserve last year in 90 days. 2 million barrels per day. So they're cutting more production than we added artificial supply last year with the SPR dumping, which was massive. So that is what this market thinks of future oil demand right now. Now, it's possible that the market is just not woken up to the reality of these production cuts yet, and maybe there's a big rise in oil prices coming. It's entirely possible. I wouldn't be terribly surprised to see it. And there's a little bit of evidence to support that, because I put another arrow back here. This is on March 31st of last year. That was the day President Biden announced the 180 million barrel of Strategic Petroleum Reserve dumping. All right. That was in response to the Russian invasion. Well, oil continued to climb for about another 3 months before that new supply hitting market started to send prices lower. So there was a little bit of a delay between the news of the SPR and when oil prices actually made a turn, and haven't looked back ever since. So it's entirely possible that the reality of these production cuts is seeing a similar delay to what we saw back in March of 2022. That it just needs, the market needs time to digest this information, and maybe there's an abrupt turn north in oil prices coming. It's entirely possible.
Well, I
Or,
think
go ahead.
I was going to say the Saudis aren't going to actually finish their cuts until July 1st. I think is when they fully go into effect. And then we're going to talk about that other thing.
Is that the Iran increase?
Yes.
Yep. So the other thing that's going on here is Iran's production has, Mitch, what were the numbers you mentioned?
Oh, they were nominally at about 1.6 million per day, but here recently they've gone up to about 3 million per day.
And this change, do you recall over what time period? Like the 1.6, was that last year's number, 2021 numbers?
The increase happened within the last 6 weeks.
Okay, so that's a lot of new supply hitting. And I hadn't seen that story, so I'm not sure if that is reflected in the quotas that OPEC just announced. But if that's the case, that's enough new supply. That's 1.4 million barrels per day right there. That's enough new supply coming out of Iran to offset what Saudi Arabia just did. So that's a possible, that's definitely a negative factor in oil prices. So maybe that's why the market is just shrugging off this Saudi production cut.
Well, and people have to understand that while Iran it may be nominally part of OPEC, they're not being governed by OPEC right now. They don't fall into their math because of the sanctions.
But I can tell you, relations between the Saudis and the Iranians are improving rapidly right now. Rapidly, as U.S. influence in the Middle East wanes, and we're being nudged out of the Middle East right now, which for better or worse, maybe that's probably for the best. I don't know. But the Iranians and the Saudis have been playing very nice in the sandbox lately. No pun intended. We've got the civil war in Yemen. Is at least the Iranians are no longer backing the Houthis. Is that correct, or is it the
It is
Saudis are no longer backing the government?
both actually. Everybody said, okay, Yemen be Yemen, but once they took the money away from the Houthis, they couldn't buy weapons anymore. So now they're trying to loan themselves out to Syria.
So without these other governments waging their proxy war through the various parties in Yemen, turns out that conflict is running out of fuel. So again, for better or worse, as U.S. influence in the Middle East wanes, it appears things are improving for the people in the Middle East, which good for them. God knows they could use a break. Um, but that's what does that mean for oil prices? What is this means, in my opinion, bearish for oil prices, right? More production coming online, less conflict in the Middle East. That's bearish oil prices. And of course, a global economic slowdown is very bearish for oil prices. And right now, you can see it right here. Oil was on its way up, and it came right to its 200-day moving average. And that report from the Saudis, or that report from OPEC that came out on, what was it, April 13th, it looks like that had more of an effect on the market than I realized at the time, because that right at the 200-day moving average, abrupt U-turn, and it's failed every attempt at a rally ever since. So OPEC is really worried about future demand, and these production cuts are, I think they have less to do with sticking it to America, and I think they have more to do with they can see demand slowing. They can see the shipping rates. They can see boats aren't moving as frequently, and the ports aren't as busy, with the exception of the labor slowdown in the States here. That's bearish for oil prices, guys. Again, global recession, less oil getting used. Less oil getting used means less food getting grown, means less factories running, less stuff selling, less stuff shipping, right? Energy and oil are inputs at virtually every phase of virtually every supply chain. So you won't find many better economic indicators than the oil markets, at least not until we find a replacement for oil, which is a long way off. All right, we talked about that one. Um, let's talk a little bit about this story here. I saw this one. I was gonna put this in a live stream this morning, but we ran a little long this morning. This is for all the people who are screaming de-dollarization, and this is another one where I'm starting to diverge a little bit from some of my peers, because a lot of the other channels that I follow, a lot of the guys I'm friends with, they're really big on the de-dollar thing. All right, it's all the rage in the media right now. And my stance for the last couple of weeks has really been like, yeah, the world is de-dollarizing, but that's not going to be an easy transition. It's not going to happen overnight. It's going to happen over years, probably decades. And right now, these countries are actually more desperate for dollars than they've ever been. We have more of a dollar shortage right now than an excess of dollars. It's hard to believe after all the inflation that we've lived through, but that's the case. And here we go. This one in the Wall Street Journal this morning: a bank China built to challenge the dollar now needs the dollar. How Russia's war in Ukraine paralyzed the BRICS new development bank. A development bank China launched with its fellow BRICS countries was supposed to reshape international finance. Russia's invasion of Ukraine now risks turning it into a zombie bank. 8 years after Xi Jinping and his counterparts from Brazil, Russia, India, and South Africa established the new development bank with a headquarters in a swanky Shanghai skyscraper, it has all but stopped making new loans and is having trouble raising dollar funds to repay its debts, according to an examination of its finances and interviews with bankers and other people familiar with the matter. So understand what they just said, guys. They created this bank to service BRICS countries for the sole purpose of de-dollarizing, and their de-dollarizing bank is having trouble getting dollars to pay its debts. I don't think I don't think you guys are quite taking the walk with me here. that I thought it was the not dollar bank. Why is the not dollar bank desperate for dollars if they're de-dollarizing? Turns out de-dollarizing is really really hard. The new development bank is the lesser known of two of China's based multilateral lenders. Its larger cousin, the Asian Infrastructure Investment Bank, this week landed in the middle of a public relations crisis after a disgruntled executive accused it of being controlled by members of the CCP. Trouble at both banks, as well as at China's giant Belt and Road infrastructure push, which has seen China spend $1 trillion to expand its influence across Asia, Africa, and Latin America, spotlights growing difficulties for Beijing's strategy to rearrange an international order it considers biased in favor of the West. Both the AIIB and the new development bank were set up in large part to reduce developing countries' dependence on dollar-based funding, alternatives to the IMF that would help finance development in some of the world's fastest growing economies. Meanwhile, the BRICS Development Bank is fighting for its very survival, threatened by its own reliance on the U.S. currency. The bank that was supposed to help them break their reliance on the U.S. dollar is struggling for its survival because that very bank is dependent on the U.S. dollar. Soon after Russian troops marched into Ukraine in February of 2022, the bank froze all new lending to Russia to assure investors that it was complying with Western sanctions. However, Wall Street quickly became wary of lending to a bank nearly 20% owned by Russia, and Xi's deepening alignment with Russian President Vladimir Putin was another deterrent. Since then, the bank has had to take on increasingly expensive debt to service old borrowings and stay current with its own liquidity requirements to bolster its resources. The bank is in talks with Saudi Arabia, Argentina, and Honduras about becoming members, according to people familiar with the matter. When it took out a $1.25 billion bond in April, its first since the Russian invasion, it was nearly 5 times as expensive as its previous borrowing. This bank needs dollars, guys, and it can't get them. Again, this D-dollar story that we're hearing about. Every time you hear a story about some country is going to settle trade in yuan or settle trade in rupees, if you peel back the headline and you get into the article and you actually read, you'll typically find that the reason why this is happening is because one of the countries involved in this transaction is almost out of dollars. Its local currency is plunging versus the dollar. And so they're trying to stem the outflow of dollars from the country so they can keep the dollars they have to use them to prop up their own failing currency. This is a dollar shortage that is happening globally, and it's being spun in the press as if the whole world is de-dollarizing and all these worthless dollars are going to come home next week and cause hyperinflation. But that's not what's happening. It's actually the opposite. The dollar is increasing in value relative to all these currencies.
Well, I think a lot of people, when you go back, and I think you did a whole video about this. Historically, there's a way this happens, right? You have a war, you get in too much debt, you lose reserve currency, someone else comes along and replaces you. Now the question is going to be: is that conflict the OEF conflict we have, which is Operation Iraqi Freedom, Enduring Freedom? That's what Afghanistan and Iraq and all that was called, right, during those
Yep.
years. So either that was our war or we have one coming up soon. And once you have that debt mechanism, it takes like a decade or more to make that transition. And that was years ago. I can imagine today.
Yeah, I mean, historically, there's been several passing of the batons, if you will, and they're not, the passing of a baton is not exactly a violent act. When reserve currency changes, it's typically a violent act. All right. There's been a couple of consistencies prior to the changing of the reserves. The existing reserve currency debases itself. It loses its peg to gold or silver. All right. Check. The U.S. did that in 1971. Right. When the Dutch lost reserve currency, when the British lost reserve currency, when the French lost it, right? They all did the same thing. They took the silver, they took the gold out of the money. All right. So we have already done that. But the new currency that has risen to replace it, right? That new currency has been tied to gold or silver. It was not debased. And that new currency was from a country that had a very large global trade empire and a very powerful global navy to protect and enforce that trade empire. All the countries that have had reserve currency status, they've been tied to gold and silver, they've had a global trade empire, and they've been one of the dominant navies in the world. All right? There is nobody in the world, there is no currency that meets that test right now. The closest one is the yuan. The yuan
Well,
is
I
not backed by
argue,
gold or silver.
I think
Good.
if you look at history, that is what has pushed the reserve currency has been a strong navy, right? I mean, all the way back to when they started it, there's always been strong navy, strong military, strong economics, right? Strong trading.
Yep.
So right now, the only one that's kind of coming up right now is India. Watch India. They just did something that China has been unable to do. They did multiple carrier operations in the Indian Ocean simultaneously. And that is a big deal in the Navy. China can't do it yet. The
Yep.
only
I did
people that
see
were
that.
able to do it so far were Britain, France, and us. Even Russia has a hard time with it.
Yep. The what's I can't remember the name of the Russian carrier, but it's out of commission right now. They can't conduct aircraft operations from that carrier. The Chinese, they have two carriers. They're building a third, but the Chinese, their aircraft carriers are basically aircraft launch platforms because the Chinese were killing too many pilots trying to learn to land how on carriers, which is not an easy skill. And so they just decided that their planes were only going to take off from their carriers. They have to land in mainland China. Well, that drastically limits the range of operation. So the Chinese carriers are really just decorations. I don't know how to put it. Like they're if they have to operate within aircraft range of land, then they might as well just launch the planes from land. They're not really full blown blue water
Yeah,
carriers.
their carriers are essentially range extenders right now. That's all they are.
Yep.
So India was actually doing the launch land cycle on two different carriers. So they're the Navy that's coming up, not China.
Yep. Now, even the India story, like I did read the story, and it said that 35 aircraft participated in the event. All right, two
Mhm.
carriers, 35 aircraft. Now, Mish, you spent some time on the water. What's the number of aircraft that one of our super carriers carries?
I will tell you that a carrier will typically have between about 90 and 120 planes when they're in the Gulf. They are floating, fully manned. They're the fourth largest air force in the world. One carrier.
One carrier. So one of our super carriers carries at least three, possibly four times as many aircraft as just participated in that Indian naval drill with their two carriers. And how many carriers do we have now? Is it 12 or 11 super carriers?
No, I think we're down to nine because the Enterprise is gone now.
Oh, we have a couple that are also being refueled. So we have nine functioning super carriers, and then another like half dozen. I think we classify them as assault ships, but they can carry the F-35B, which is the vertical takeoff and landing.
Yeah,
So
those are the LHD, the Jeep carriers.
LHD. Yep.
So what we have typically is you have two carriers deployed, two in ready standby, and then the rest of them are either going up or down in the cycle. Either going into the yard or they're coming out of the yard.
And then factor in take all the other aircraft carriers in the world, and 80% of them are U.S. allies. So the
Mhm.
French have a carrier, the Japanese have one they just put in service. I think the Japanese they have two now or one, or the British have two. So I mean, there's not even close to matching the naval power. Now, there
I
are
spent I
some.
spent a week and a half on a British carrier, and their largest casualty is loss of all air because all of their switches are done by air. Where we do it electronically, they use air pressure.
Okay, compressed air
Mhm.
operates there. I can see that. So, now there's other concerns, right? Like the Chinese aren't really making an effort to challenge America's carrier supremacy. They're investing a lot of money in long range hypersonic ballistic missiles that are claiming to be carrier killers. And, we didn't find out until World War II started that the battleship was obsolete, right? So it's possible there's a changing of the guard that's underway as far as projecting power over the ocean, but that hasn't happened yet. And as far as the existing who's got the big guns on the water. It's not even close. Not even close. So the all of the ingredients, we got a little sidetracked there with the Navy thing, but all of the ingredients of a reserve currency, there's nobody who meets that test. There's no global currency backed by gold and silver. There's no Navy that can challenge the United States. China may have a trade empire that's on par with the U.S. or arguably bigger, but they don't have a blue water Navy that can enforce it, and their currency isn't backed by gold. So, I mean, the only thing that really comes close, I've mentioned this before, and I'm probably going to get a few boos from the silver bugs here, but, the only thing that comes close is Bitcoin. Bitcoin actually is a reserve currency for some countries right now. Bitcoin does have managed scarcity. It's not backed by gold or silver, but its supply is limited, and they don't have a navy or a trade empire. But does Bitcoin need a navy or a trade empire? Maybe not. I don't know. But there is nothing right now that satisfies the historical test of the qualities to become the reserve currency. Nothing. So the U.S. may lose more reserve status to other currencies, but nothing will rise to replace it. At least nothing that's in existence today. Now there's rumors that BRICS is going to launch a gold-backed or a commodities-backed currency. We'll have to wait until that happens and look at what it is and what's in it to see if it's really a threat or not. But that's right now just a theory, a sketch on the back of a napkin somewhere. It doesn't exist yet. So I'm not too worried about all that. All right, and last thing we're going to talk about today, guys. This story. Oh my God, I tweeted this one out this morning. Billionaire Rubin brothers sue Trafigura over nickel fraud. All right, now here's one for you silver bugs out there. All you guys who you bought metal during the silver squeeze, you're sitting here saying, when silver squeeze, when COMEX smash. I don't know when, but I can tell you the fraud in the commodity space is rampant and it's starting to be exposed. Check this story out. Legal filings describe counterfeit shipping documents circulating in the nickel market and containers being shipped back and forth around the world without being unloaded. So remember last year when the LME nickel market broke and they shut it down and they reversed trades? That was amazing that they reversed trades. Oh, your nickel is up 50-60% since you bought it. Sorry, we reversed the trade. We'll give you back your cost basis, not what your nickel is actually worth. What? A lot of people left the London Metals Exchange over that. But here we go. More fraud in nickel markets. Trafigura Group is being sued by billionaire Rubin brothers as the fallout of a massive nickel fraud reverberates through global metal markets and ensnares some of the industry's best-known figures. Legal filings seen by Bloomberg shed new light on the case that shocked the market earlier this year when Trafigura said it expected to lose nearly $600 million in what it called a systemic fraud perpetrated by Indian businessman Pratik Gupta. In them, Hyphen Trading Ltd., the company owned by the Rubin brothers, which is bringing the legal proceedings, alleges that the fraud didn't just involve thousands of tons of missing nickel, but also counterfeit shipping documents, which ended up being used to obtain financing from leading commodity bank ICBC Standard Bank. It describes how containers supposedly holding the nickel were shipped back and forth around the world, apparently to avoid having to open them to reveal their true contents. Moreover, Hyphen accused Singapore Freight Forwarding Company of being involved in Gupta's alleged fraud. It also raises questions about Trafigura's own actions, saying that the trading house stonewalled its request to inspect its cargoes. Spokespeople for Trafigura and the Rubins declined to comment. Now, it goes on to talk about how we don't know what was in them or if anything was in them at all, these containers, how they were moved around. It actually talks about it in the, for $8.4 million, Hyphen bought just over 404 tons of nickel that had been loaded in Kaohsiung, Taiwan, onto a container ship called the OOCL Jakarta. So we're starting in Taiwan, all right? This company, Hyphen, that's owned by the Rubin brothers, they buy $8.5 million worth of nickel, and it starts to ship from Taiwan. They buy it from Trafigura. They put it on this container ship called the Jakarta. The plan was for Hyphen to take delivery of the cargo when it arrived in Rotterdam. For a few months, it was financed via a repurchase agreement with ICBC Standard Bank. So now we've got this bank as a player in here. Of course, the spokesman from the bank wouldn't comment. Things didn't go smoothly. When the containers did arrive in Rotterdam in mid-November, on a different ship, not the Jakarta. No one told Hyphen, the company that had bought the metal. Instead, they inexplicably remained on the vessel when it set off on its return trip to Asia before the nickel, air quotes, was finally unloaded in Jeddah, Saudi Arabia, according to the complaint. So the metal was supposed to be shipped from Taiwan to Rotterdam on this boat. It shows up in Rotterdam on the wrong boat. They never take it off the boat. They go to send it back to Asia, but first they stop and unload this imaginary nickel in Saudi Arabia. By December, Hyphen was still in the dark about the whereabouts of its cargo, and alarm bells were starting to ring. Together with Argentum, a U.S. hedge fund it was working with, the trader began to press Trafigura for information. And guys, Trafigura, this is not some small mom and pop little family office. This is one of the biggest commodities trading houses in the world. Trafigura is doing this. On December 16th, Hyphen asked for information concerning where the goods had been stored at Kaohsiung. This is in Taiwan before shipment. Trafigura didn't reply. Hyphen pressed for a response on the 19th, 20th, and 22nd of December. Argentum, the American hedge fund, pressed for the 20th, 21st, and 22nd. Trafigura still didn't reply, so they're ghosting their customers. Finally, on December 27th, Trafigura did respond to a demand for an inspection. According to Hyphen's complaint, it allegedly refused the request, citing logistical complications. So, after months of this container on the wrong boat in the wrong place, Trafigura is ghosting them. Finally, they get somebody on the phone and they say, no, you can't inspect your cargo. It's too hard. Logistical complications. By that point, unknown to the wider market, Trafigura was in full-blown crisis mode. While Hyphen executives were becoming increasingly frustrated with Trafigura's lack of answers about the cargo, Trafigura executives were in a similar state of agitation. 2 months earlier, Citigroup suddenly informed the company that it would no longer finance any trades with firms linked to Gupta. And by December, Trafigura was applying almost daily pressure on Gupta for information, according to the court filing. On February 9th, Trafigura publicly accused Gupta of fraud in a jaw-dropping announcement, saying it had spent more than $500 million buying nickel from his companies, only to discover when it opened the containers that there was no nickel inside. $500 million. Gupta's spokesperson has said he's planning a robust response to Trafigura's allegations. So, guys, this isn't just a case of like one bank papering over the nickel market. You've got hedge funds. You've got international banks. You've got the biggest commodities trading house in the world. You've got this Gupta guy, whoever he is. You've got players in Taiwan. You've got players in Rotterdam. You've got multiple ships involved. You've got Saudi Arabia involved. This is a mess. This is a real mess. And you know what? There's no metal backing it. They were forging bill of ladings. They were producing fake documents. They were papering over the market. They were just moving around empty containers, bags of rocks. I remember they were talking about that. And nobody has bothered to look at the silver market yet? Really, guys? Really? This is unwinding, guys. This stuff, if they're looking at nickel, sooner or later, somebody's going to look in the metal. So, hey, Rubin Brothers, ask your friends about silver while you're at it, guys. If you like what the nickel market has done, think about silver. So I saw that one this morning, and when I saw how they had moved this thing all over the world and the players and Trafigura's involvement in the way Trafigura was treating their customers here, that's a big deal. Very big deal.
Well, you want to, markets are closed. Do you want to go back through them real quick?
Yeah, let's take one last look. S&P ended up closing down 16 points on the day, closed at 44.09, still a very good week for the S&P. We got the Dow closed down 108. It looks like it sold off pretty hard in the closing, or about 0.32% at 34,299. Again, still a pretty good week for the Dow. And how's my SQQ doing? Looks like it's doing all right. The NASDAQ leading the way lower, down 0.2% today, or 93 points, 13,689. So despite the sell-off today, markets had a really good week. All things considered, yeah, that was a really good week. Now, let's see. Will history vindicate me and my QQQ calls, or SQQQ calls? Sorry, that's a big difference. Will the markets do this like they did the last time we were up here in the RSI and the last time the Fear Greed Index was this high? I don't know. All I can tell you guys, there's one thing you take away from this, I'm not just pointlessly negative. There is math, there are charts, there is fundamentals behind my perma bearness here. Okay? And the bulls, congratulations to the bulls. You guys have been right. All right. I sat out this rally. So all you bulls who have been taking cheap shots all these last few weeks, congratulations on your gains. Might I recommend you take some advice from my man Mish here and actually book some profits? Isn't that the point? Isn't that the point, to make money? If you never sell, you never actually make money. Or, just keep saying AI and hope the market keeps going up forever. And guys, that's about all I got for you today. Now, what do we got going on next week? No Fed next week. Now we got pretty much nothing next week. So
Yep, nothing.
Yep. We had a big week this week. The market dodged quite a number of bullets this week. It dodged the Fed bullet. It dodged the CPI bullet. Dodged quadruple witching. A little bit of a sell-off in the close. But all things considered, market shrugged everything off this week. Can't do that forever. All right. Mish, you got any last words you want to throw in there, brother?
I'm going to do a quick 3 thing here. If you need to make a phone call to go home. Don't add to the population or take away from the population unless you mean to.
All right, that's solid life advice. You're a real philosophizer today, aren't you, brother? All right, guys, I want to say thank you for your time. Thank you for joining me. Thank you for indulging my perma-bearness today. You guys are awesome. And also thank you to all you folks who stuck with me through the tech issues yesterday. We had like 100 people hung out on that premiere that never started. I opened a ticket with YouTube support. They're going to get back to me on what went wrong. I don't know. I love Klaus Schwab. I can't wait to eat bugs. Maybe now my tech issues will slow down. All right. Thank you very much also to Patriot Gold for sponsoring this live stream. Thank you to my Patreon supporters for everything you guys do. Hi, Mom. Hi, Dad. I love you guys. And look, folks,
Hold on.
hard times coming. Wait, go ahead.
Someone snuck in.
What do you mean somebody? Oh, who was that? Was it EC660 again? It
No,
was
it's Grandpa.
Grandpa. Very sneaky, sir. Very sneaky. There he goes. I know when my buttons are being pushed. Buy yourself 2 cases of Bud Light this weekend. I appreciate the spirit of the gesture, Grandpa. I'm not going to bite on that one. I mean, we just got done talking about unexplained technical difficulties going on with the algo. You want me to weigh in on that? Oh, yeah. The algorithm will just love it if I weigh in on that subject. Let me just weigh in one little thing on the subject, okay? The point of doing business is to do business. Companies that there's this trend of companies being forced to take positions on controversial subjects, whether for or against whatever they are. The companies that resist are going to capture market share. I can tell you that. This ESG thing, the BlackRock and Vanguard using other people's money to extort political behaviors that they find favorable, I don't think that's a trend that's going to carry on. I don't think that's going to last. So, the companies who have resisted said urges right now are capturing market share from the pushback. And it's not to take a side on a controversial subject. It's like, just make beer. What a concept. Just make beer. Just sell stuff. Just do business. You don't have to take a position on every subject, right? And case in point, this channel. This is a finance channel. We don't need to weigh in on this stuff, all right? The orange herring story that I talk about all the time. We don't need to talk about it. Everybody else is talking about that. It's a finance channel. Let's just stick to finance. All right, so thank you very much, Grandpa. Very sneaky, sir. Very sneaky to sneak that in right as I'm about to sign off. But I appreciate very much the super chat and support of the channel. And I got a kick out of you trying to push my buttons and get me spun up. So thank you very much, sir. I appreciate that. All right, guys. Tough times coming, but they're not here yet. So I want you guys to all have an awesome, awesome weekend. Hug your kids. Hug your wife. Hug your husband. Spend time with family. Make the most of this. Hard times are coming. They're not here yet. There will come a day where you wish you had today's set of problems. So enjoy the good times while they last, everybody. Till next time, live small and dream big.